Hi, it's Danny at Divine, and it's Friday, March 18th, and the end of a really wild week in the markets. I'm going to talk a little bit about what moved markets this week and what we are doing about it. So looking at the big picture, we're in an environment of really outstanding economic strength. The labor market's at an all-time high. There were 11.3 million job openings at the end of January, which is like 1.8 open positions per unemployed person. And unemployment benefits that are paid by our government were the smallest in 52 years. We saw reports this week also that economic strength was evident in manufacturing production, as well as there being a sharp rebound in home building. So all of this in the face of two main market agitators, and you know what they are: inflation and the war in Ukraine. So inflation, the Fed raised rates this week by 1/4 percentage point. They said they're going to raise them to about 2% by the end of the year. But Fed funds rate is at 1/3 of 1% right now. And headline inflation is running at almost 8%. And data on Tuesday showed producer price indexes in February are at 10% a year, which makes this all seem like a little bit of a joke. Inflation is a byproduct of massive quantitative easing and all the government assistance during the pandemic. Keep in mind, this is not a Joe Biden done us wrong situation. When astronomical amounts of money are pumped into an economic system, and this was on a global basis, what you get as a result is inflation. Inflation in the price of gas, of food, of energy, of services. The severity of the housing shortage and housing costs are making a lot of places unlivable. And let's talk about the war in Ukraine. To be clear, the cost of this war is immeasurable. The lives lost and the suffering of so many millions. And we really don't even know how long this war will go on. There are so many impacts that we can't even measure, but there are some that we can. And Ukraine is one of the 5 biggest wheat exporters. And so is Russia. The United States, Canada, and France are the other 3. And those 5 make up 64% of wheat exports. So basically bread, cereal, meat, everything that you're about to buy this weekend at the supermarket, the price of that is going up. So what are we doing about it? There are a few positions that we've added to since the market has been down almost 13% this year. We've added to positions where we've seen significant pullbacks in stocks such as Alibaba and gold, Barrick Gold. We've opened up some new in positions in inflation-protected funds and ETFs, exchange-traded funds. And one exchange-traded fund that we bought is a commodity fund, and it invests in global commodities markets and buys futures in commodities like cattle and cocoa and gold and soybeans and wheat and sugar and oil, silver, things like that. And essentially, they're not buying those products and they're not producing those products. Essentially, they are buying a futures contract. So that's a legal agreement to buy or sell a particular commodity in the future at a predetermined price. So this ETF doesn't take ownership of any of these things, but it's a bet that commodities prices will rise in the future. And when markets get really messy, and we've been through a few of those together, but there are some downturns for a short period of time, some for a long period of time. Expect to see more activity in your account because we're taking advantage of values that really only come along every so often. And I just want to say, sometimes things get ugly and they get ugly for a little while. So you don't see like an immediate return to normalcy right away. But I want you to know that in markets like these, we're really working hard for you. Thank you so much for watching. Please schedule your quarterly appointment with us and keep those questions coming. Send me what you want me to talk about next. We'll see you soon.